Buy low, sell high. It's a phrase many of us have heard, yet few truly know how to apply it effectively. But what if we tell you there's an indicator that not only mirrors every market peak, but also helps you master investing in global stocks, currencies, bonds, and commodities? Welcome back to Macro in 2 minutes. In today's video, we'll explain what the Manufacturing Cycle Index is and how it can enhance your investment strategy. The manufacturing cycle has two main phases, the rising cycle and the down cycle. A rising cycle occurs when there's a rebound in declining order demand while inventory is low. Realizing a supply shortage, manufacturers will increase production to meet demand. A down cycle occurs when order demand slows, leading to rising inventory. Manufacturers begin to reduce production to clear out excess stock, indicating a pessimistic economic outlook. On average, each cycle lasts about 1.5 to 2 years, making a complete cycle around 3 to 4 years. After understanding what the manufacturing cycle is, we'll teach you how to leverage this single indicator for investing during various phases of the economic cycle. The stock market typically trends upward over the long term but experiences corrections of over 15% every 3 to 4 years. Does that sound familiar? This pattern aligns with the length of a complete manufacturing cycle. When the manufacturing cycle peaks or starts to decline, the stock market usually reacts within 6 to 12 months. Another way to use this indicator is to identify the best time to invest in cyclical versus defensive stocks through a tactical rotation strategy. During the rising phase of the manufacturing cycle, the ratio cyclical to defensive stock price increases, suggesting a better opportunity to invest more in cyclical stocks like automotive and technology. Conversely, during downturns, pivoting towards defensive stocks such as healthcare and consumer goods can be beneficial. By applying this strategy, you could potentially amplify your returns tenfold. Finally, the manufacturing cycle can guide when and how to invest in emerging markets and the US dollar. Since most emerging markets are manufacturing dependent, they are positively correlated with the manufacturing cycle. A downturn in the cycle leads to emerging market stock declines or even crises, like the 2015 Chinese stock market crash. As emerging market stocks fall, capital outflows and currency depreciation follow. Investors then shift funds to safer markets like the US, causing the US dollar to appreciate, making the dollar negatively correlated with the manufacturing cycle. Thank you for watching. Click the link below to visit our website and learn more about how to leverage the manufacturing cycle for investment strategies. Don't forget to like and share this video, and we'll see you next time.